All right. Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Blind Run on the internet and Matthew in real life. Today we're going to be talking about the cryptocurrency market recovery. Is it real? Are we back in a bull market, or are we going to remain in a bear market for the foreseeable future? I'll give you my thoughts, and I'll give you the thoughts of other people within the industry. We're also going to be talking about the merge a little bit more because that is impacting price on, of course, Ethereum and the cryptocurrency market as a whole. I have an opinion piece here, which is interesting, that is talking about mining when it's not profitable. Who says Bitcoin mining needs to be profitable, huh? We're going to be talking about that. That is probably the most interesting one. Other than that, we also have Intel Arc Alchemist information, performance, price, and availability. Everything we know so far about the new Intel Arc Alchemist. I'm excited to go ahead and take a look at it. We'll also be talking about Flux partnering with the Sunflower Corporation, as well as a new node, well, not node, but an update to Caspa. You need to update your nodes. There you go. Let's get into it right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. And welcome back, everybody. So, first things first, Caspa version 12.4 is out. It was released yesterday. They fixed basically something for the UTXO difference mechanism, and they implemented a multi-layer auto compound. Now, this is a small update. However, it is a critical update. So if you're running a Caspa node, my understanding is you do have to update it. I was like, bro, no, I've already been updating nodes all night. So I have not updated mine yet, but it is here. It is out and available. So if you're solo mining Caspa, just make sure you're aware of that. Links are in the description to the GitHub if you need to get a pull done and get that updated on your end. Other than that, we have the Flux. There's a Flux trading competition. It's part of a promotion for the cooperation of Flux and the Sunflower Corporation. Basically, down below, I guess if you want to get into the competition and all that, that's there. The main reason I'm bringing this up is because obviously there's a new partnership. So there is a 1 second, I'm going to have to go take care of something at the door, and we'll be right back, I guess, at this point. So give me a sec. special delivery. Hold on, you'll see. Octo miners. They're here. Waiting for him to get the other three, then I'll bring them in. Okay. So, we got 1, 2, 3 here. 3 more coming. I thought we were getting 8. Today we're getting 6. It's an N, not a Z. X12, X12, X12. 3 X12 Ultras right there. I should have 6 of them. Excuse me, bud.
Did you get the packages?
I'm waiting. He's bringing some more up.
That's all recycling?
Well, I'm waiting on him to get the others out of the truck. So that was fun. A little bit of a unexpected surprise for the stream, I suppose. Yeah, look at that delivery time.
What are those for?
For mining, but you can't get out. Get out. I'm still live streaming. When I say get out, I mean get out. Come on. Stop, honey, but come on.
Can you go put this in the recycle bin? In the garage?
The wife said, "That's a 2-person lift required." I was like, "I do jujitsu." Hold on, we got more.
Victor, I told you to put that bag in the bin. Not in the laundry room. Here, you take this one also now. Take this bag too.
More. 2 more. We got all of them in today, I think. What if these just fall over? What if these all just fall over? I got more. Hold on. Well, it doesn't fall on my computer.
I know that I need to delete.
Alright, so what I see is 3 more. I see 3 more ready to come in.
What are you gonna do with those?
Nope. this stuff.
You have to put it on the side.
Just go like this.
Dada, I'm gonna build another computer. I'm gonna build another computer.
It's fine. We got this. All right. How about we get back to the show? We have 9 Octominer X12s back here ready to go. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we got 2 X8s at the farm. So I think we're pretty ready to go. Octominer was like, deliver it during the live stream. Actually, these have been caught up in customs for a while. So they're finally here. But let's get back into Flux. How about that, huh? So Sunflower Corporation has launched a Flux USDT contracts on July 18th. To celebrate, they want it will be launching a campaign that users can trade a new contract to win a share of 10,000 USDT rewards. All users that register for a Sunflower Corporation account during the competition period and trade 200 Flux or more effective trading volume, including buys and sells, will share a prize pool of $10,000 worth of USDT. The reward will be split based on each user's total trading volume as a proportion of all qualified users' total effective trading volume during the competition period. The reward for each qualified users equals each user's total effective trading volume over all users' total effective trading volume. For the fairness of the competition, market makers are unavailable to participate in it. Trading volume counts both buys and sells. Sunflower Corporation reserves the right to disqualify trades that are deemed to be wash trades or illegally bulk registered accounts, as well as trades that display attributes of self-dealing or market manipulation. The sub-accounts and the master account will be regarded as the same one in the activity. Rewards will be distributed within 3 working days after the activity, and Sunflower Corporation reserves all rights to the final explanation of the event. So that is what's going on as far as the competition goes, and it's between essentially Sunflower and Flux. Now, Flux obviously has just been doing partnership after partnership, left and right and left and right. Some of them work out okay, some of them don't, like the UST Terra cooperation that they had going on. So, you know, to me, it seems like as far as Flux is concerned with all their cooperations and partnerships and parallel assets, they're more of a quantity over quality kind of mindset. They're just throwing everything they have at every single cooperation they can get their hands on, and that can be good for, you know, interoperability down the line, but it also can be obviously damaging when you run into an issue like UST Terra Luna type situation. So, You know, it is what it is. What are your all's thoughts on the amount of partnerships and everything that Flux is doing? Is it a little too much? Do you think they should slow down and perform some more due diligence on some of these projects before they go into them so heavily? And I asked that question because I think like there is the question of like getting into legal issues and so on down the line when you're partnering with so many people. Like, what if UST Taro had been fully deployed on Flux instead of just announced? Would that have completely changed, you know, essentially how Flux reacted to it? Instead of like a 15 to 30% dump like we saw with Flux, could it have, you know, basically been a lot worse? Now, we do have some hardware news. Intel Arc Alchemist XHPG GPU specs, performance and price and availability available. Everything you need to know. The much-awaited entry of the Intel in the discrete graphics segment is getting closer and closer as the company gets ready to launch its first Alchemist GPUs for gamers based on the brand new XE8HPG architecture. Now, the product info had said, you know, we were going to get a Q1 2022 release date. That was sort of true, but they were OEMs and they were all overseas. So, you know, if you were in a Western country, you didn't see that happening, unfortunately. When we talk about GPUs, only two names come to mind, AMD or NVIDIA. Both companies have been offering their latest GPUs for a diverse range of markets. These include desktops, mobility, workstations, and servers. Intel hasn't had a profound presence within the graphics segment yet. They have the highest GPU share of all companies. Why is that the case? Well, Intel has had GPUs, but only in integrated ones that are found on almost all of their CPUs. Whether consumers use those GPUs is a whole different thing. Now, for the most part, if we're talking about install base though too, really most PCs, at least for in the past 10 years, have only had an Intel CPU, and you do all of your tasks off of the integrated Intel CPU. Not to mention when Intel had their partnership with Mac and they were in all of the MacBook Airs and all of that until you got up to maybe the Pro where you got an integrated graphics. It's pretty safe to say that most of them are in use as well. That being said, of course, if you want to get any sort of real graphics works done, or you want to actually get some, you know, gaming done, you probably would get a discrete GPU. And in that case, then no, you weren't running the Intel GPU, right? The integrated one. Intel is now aiming to change that. In fact, for the last couple of years and ever since the formation of their Visual Technologies Group, which is headed by Raja Koduri, the company is set to release a brand new graphics architecture that is all set to enter the GPU world in 2022. Meet Arc, the brand new chapter of Intel's graphics vision. Now, it's interesting because Raja actually came from Radeon. So he came from Radeon when basically Radeon was doing very poorly. Radeon's barely recovered with the 6000 series. Obviously, they took the traditional rasterization crown with the 6900 and the 6950 XT. They're still behind on ray tracing. However, obviously now with the departure of Koduri, and I don't know how the roadmap worked out, right, if he helped work on this, but after the departure is when we saw the 6000 series come out. It's basically, we'll also be seeing the 7000 series, which looks to be extremely, extremely well placed against NVIDIA. And then on the Intel side, as far as I'm seeing it with these particular, you know, reveals, it doesn't look like they're going to be that competitive. They're also having a very weird launch time. These are competitive barely with like mid-range current gen GPUs, and we have the new generation of GPUs coming from AMD and NVIDIA in Q4. So we're looking at like a Q3 launch of the Intel Arc GPUs onto the, you know, the Western markets, etc. And then right after that, we're going to have 4000 series and 7000 series from NVIDIA and AMD respectively. So we know that the brand name from Intel is Arc. That's cool. And let's go ahead and get down from here and get some more information as far as this goes. We also have come to know that the product, what the products will be called. So they're going to be the A series, right? So the A770, the A750, but overall you have an A300, A500, and A700. So there's like 3 steps of performance essentially. As far as everything else, the Intel Arc Alchemist GPUs are designed primarily for desktop and notebook platforms. From the information that we have currently gathered, the lineup will consist of 2 GPUs, and each of those will have various SKUs, and each of those SKUs will be featured in a range of solutions for desktop graphics cards and mobility GPUs. All Intel Arc Alchemist GPUs will utilize the TSMC 6nm process node. Another point about that, of course, is going to be that on the AMD side, we're getting down to 5nm. And then on the NVIDIA side for the next gen, it's going to be basically a modified version of 5nm that will be slated as 4nm. Albeit, you know, the competition is very interesting between AMD and NVIDIA this time around because you have NVIDIA going to a multi-chip module design as well as hitting over 3 gigahertz on their core clocks. And even with a smaller manufacturing process or a modified 5nm manufacturing process going down to 4nm on the NVIDIA side, it's only slated to hit like 2.7 gigahertz. So the actual core speed is looking slower on the NVIDIA side, and it's taking a lot more power. But that being said, both companies seem to be way ahead of Intel at this point. Each vector engine is composed of 8 ALUs. In total, we are looking at 128 ALUs per Xe core. The Xe core further features its own dedicated 192 kilobyte L1 cache. So that is a total of 6 megabytes of L1 cache on the complete chip. Intel fuses 4 Xe cores together to form a render slice, which is composed of 4 ray tracing units, 4 sampler units, geometry rasterized in HIZ engines, and 2 pixel backend blocks with 8 units on each. These render slices are put together to form the main GPUs. The flagship is composed of an 8 render slice configuration, which features 32 Xe cores, 512 vector engines, and 4,096 ALUs. There will be a different configuration with 2, 4, and 6 render slices, but we are focusing on the flagship part. It will feature, the architecture will be able to achieve 1.5 times higher clock rates than the XELP and also deliver 1.5 times the performance per watt. This means we're looking at clocks of 2.1 gigahertz range, considering the XELP discrete GPUs were clocked at 1.4 gigahertz. It also means that Intel will be able to squeeze an additional power out of the architecture should they want to without increasing the power draw, or reducing the power draw while keeping performance constant. Out of the 2 GPUs, the first one will be known as the ACM G10. This is the top SKU and will be featured in the mainstream and high-end designs. The second GPU is known as the ACM G11. This is an entry-level SKU, and as such will be featured in the entry-level and mainstream designs. Each GPU has its own SKUs with different specifications. They go into more detail on all of the different features, including things like 8K 60-bit HDR encode and 10-bit HDR encode, some of the other codec support that they have, as well as creation tools including FFmpeg, Handbrake, Premiere, DaVinci Resolve, XSplit, and so on. On launch, I'm sure, of course, OBS is included in there for the content creators out there. In addition to that, Intel Arc Xe display engine will support the latest display standards such as HDMI 2.0B, DisplayPort 1.4a, and 2.0 10G support for a variety of high resolution and high refresh rate modes for obviously your monitors. You know, basically being able to run up to 2 8K 60 HDR panels. That's not pushing games at that, to be clear. That's just rendering out and being able to have your workspace in them. And then 1080p up to 360 hertz and 1440p up to 360 hertz. As for adaptive syncing technology, Intel's discrete Arc Alchemist GPU will support both adaptive sync and speed sync technology. The former will sync the display's refresh rate to provide a smooth and tear-free experience, while the latter will speed up the latest frame. That's interesting, delivering low latency, no tearing, and no cap. There's also a third mode known as smooth sync, which will blur distracting screen tears with a dithering filter. So down here we have all the specifications. Obviously the one we're most interested in will be the 780 with a 256 memory bit bus. And that's obviously because as miners, what we're looking for is that memory performance, because most algorithms are memory intensive. Now we looked at the 192-bit version, and what we found was it is going to be similar to RTX 3060 hash rates, you know, outside of fully unlocked, preferably is what we would expect to see as far as from a total memory bandwidth position. However, we are looking at 200 watts versus the 170 watts on the 3060, so not as power efficient, but depending on pricing, it could still be good, and it's yet to be seen how well the drivers will work as well as everything else once we start getting miners integrated into it. So that's pretty much it as far as all of this is wrapped up. They didn't actually announce like a release date so far, so we're still waiting on that. I think the expectation is like right before the launch date of the 4000 series from AMD or from NVIDIA and the 7000 series from AMD. So we're going to have to wait and see. Now we have a pretty interesting opinion piece here, and I wanted to go over it with you guys because we are miners and we are mining in a bear market, and some people are starting to be, you know, unprofitable. And this opinion piece says, who says Bitcoin mining needs to be profitable? You know, in addition to profits, Bitcoin mining can also offer consistent electricity demand and can clean up the air by utilizing electricity made from wasted methane. This is an opinion editorial by Mickey Koss. So Mickey, what do you got to tell us here? You know, what do you got to tell us for us home miners spending all this money on power and not earning enough? He says, I've heard some recycled fear, uncertainty, and doubt recently about transaction fees on Bitcoin network not being able to sustain the miners and thus maintain security once the block subsidy gets too low and or disappears. To give you guys an idea of what this means, we'll go over this once again. There's something known as the halving cycle in Bitcoin. The halving cycle refers to the amount of Bitcoin that is being minted per block that is being solved by the miners, and that newly minted Bitcoin gets paid out to the miners. The halving is every about 4 years or so, and what happens is that amount that is of newly minted Bitcoin is cut into half. And the problem is that once you get lower and lower on that halving cycle, the miners are making less and less, which is why you see a price correlation to it, because obviously miners still have to pay for their power. So the price of Bitcoin goes up to cover those costs, and then you get this kind of euphoria spike every 4 years. But the other thing that's interesting about that is as it gets lower and lower for the newly minted, there will be more of a reliance of the miners on the fees. Now, the fees are what the actual users of Bitcoin pay to have their transactions processed, essentially. And in a blockchain, what you end up having is a reliance of miners on those fees. The reason why, just to give you guys an idea, Ethereum has been more profitable than Bitcoin as far as from the mining perspective goes, is because Ethereum has had extremely high fees, especially during peak times when like a new NFT launch happens or something like that. So over the past year, when you've seen Ethereum mining is more profitable than Bitcoin mining, this is what's been happening, is you have really high fees. Well, Bitcoin has much more stable fees. So this doesn't really happen on the Bitcoin side of things. And the worry here that he's talking about is because the halving is bringing that newly minted Bitcoin block reward to a lower level, the reliance on just transaction fees is heavier on the miners, which means that potentially the miners won't be able to make enough to stay afloat. That's the idea. Besides the obvious observation that they're assuming no network usage growth and perpetually low fees on the base chain, I believe there are two key underlying assumptions that need to be addressed. One, mining hardware will continue to exist in its current form as standalone single-use computers. And two, mining companies will continue to exist in their current form as large standalone companies that must constantly strive for profitability or go out of business. The name of the game here is utilizing waste. In its current form, electric heating elements create heat through the use of resistors. Resistors resist, changing the flow of electricity and dissipating the electrical power in the form of heat. You're essentially utilizing poor electrical conductors in order to create heat. Seems pretty wasteful to me. In terms of miners, their main waste product is heat. Imagine the applications you could build utilizing Bitcoin-specific ASIC chips. I see a future when every furnace and water heater produced utilizes ASIC chips as the heating element rather than the traditional electrical resistor types that exist today. Mint Green in Canada is already doing this at a pretty large scale. They utilize their waste heat from the miners to heat local businesses like breweries, sea salt distilleries, and even greenhouses. This changes the whole mining profitability math completely. When utilizing dual-purpose applications and harnessing the heat originally characterized as waste, the applications don't need to be profitable in the traditional sense anymore. The use of the newest generation of ASIC chips for heating purposes is not necessarily needed nor desirable. Bitcoin mining heating applications, especially at the retail level, simply need to use the same amount of electricity or less than their non-mining competitors. The little Bitcoin that is mined is simply an added benefit for upgrading your system or an incentive for builders to put in new homes or into new homes. Why would you want to buy a home that wastes electricity by simply heating it? That's old school. I want a home that heats up and pays me when I heat it. I want a Bitcoin smart home. To understand the second assumption, you first need to understand how electricity is generated. Electricity generation capacity consists of three main generating sources: base, peak, and intermediate load generation. Base load power generates the minimum amount of electricity in order to satisfy the minimum level of demand in the system. Peak load generation is used to meet peak demands periods when demand spikes. It is ramped up and down, making it less efficient and more expensive. Intermediate load is also a variable source which responds to changes in demand, bridging the gap between base and peak load. If we have variable capacity on hand, that means that at least some of the time we have unused capacity, valuable capital, that's not being utilized. What this means is that your electricity costs not only have to cover the cost of production, but also must subsidize the cost of all the unused but necessary capacity electricity producers have to maintain. Right here he has a picture of the average hourly electricity load during the typical day by region and selected months. Look at how dark Texas is. Why so much complexity? Because demand is not constant. The above graphic shows the average demand for electricity and just how volatile it is, not only by region, but also by season. If power plants produce too much electricity, it can actually damage the grid, leading to a blackout. There are a few techniques to store excess energy, such as pump storage hydropower, but they all have limitations such as access to water, space, and battery technology. Simply put, once your battery is full, there's nowhere else for the energy to go, which ultimately leads to power curtailment. It's also why intermittent sources like wind and solar will likely never be a sole source of power for the grid. There's simply not enough storage capacity to keep the system running when the sun isn't shining or the wind isn't blowing. Bitcoin, of course, fixes this. Right now, we see miners as standalone companies buying electricity on the market from electric companies. If the Bitcoin price goes down or costs go up, miners get squeezed and go out of business. It's a viciously competitive industry, but what if it wasn't? What if mining became a service rather than a standalone business? He says, in my humble opinion, the only way forward for a truly sustainable energy system is one that is based on nuclear power. Nuclear power, however, is a baseload energy generator. You can't really ramp it up and down. The electricity produced must be consumed or literally wasted by sending it into the ground. So what do we use for variable demand? He says his answer is Bitcoin. Instead of building capacity in variable forms, using up a bunch of capital for assets that are only used some of the time, why not build a massive base of load of nuclear energy and use Bitcoin mining as a variable demand to smooth the electricity demand curve? This is what we've been talking about on this channel for a long time, and I think that this article articulates it very well. It flips the paradigm on its head. Not only do we need a massive source of clean and sustainable energy, we also utilize all of our capacity all of the time. The only variable being how much hash rate the power plant produces throughout the day. In the meantime, Bitcoin can be used to utilize all of the grid's energy producing capacity. It will increase power company revenues, providing them with more capital to invest and build out infrastructure. Through the integration of Bitcoin mining and energy production, Bitcoin mining no longer has to be profitable in the traditional sense. It simply needs to outweigh the opportunity costs of not producing electricity at all. Furthermore, the increased utilization means that consumers are no longer subsidizing unused capacity in their monthly bills. Imagine electricity rate freezes or even cuts. At the very least, power rates wouldn't need to rise nearly as fast. What's good for the goose is good for the gander. If a clean, sustainable, resilient, reliable, and affordable electric grid is your goal, Bitcoin is the way. Waste products like natural gas and methane have been nothing more than an expensive cost of business for some time. All of that is beginning to change at a rapid pace. Whether the gases are produced through the breakdown of buried trash at a landfill, the drilling for oil, or the excrement of livestock and people, those gases can now be harnessed and monetized through the use of generators to mine Bitcoin. It's already happening. ExxonMobil is just one of the companies starting to do this. Natural gas is a byproduct of oil drilling and extraction. In many cases, it was simply not economical to bring the gas to market, forcing producers to flare or, even worse, vent the gas directly into the atmosphere. Now the waste gas can be routed into a generator and used for Bitcoin mining. It incentivizes companies to be more careful with that waste gas because it has been transformed into an income-producing asset rather than a pesky cost of business. Landfills are also facing the same incentives. As garbage breaks down under the surface, it produces methane gases. Those gases, much like oil producers, were often flared or vented. With Bitcoin mining, the methane is now an asset to those companies, incentivizing them to become better stewards, reducing their air pollution. Even human waste can be monetized with the Bitcoin mining. Wastewater treatment plants typically use anaerobic digesters to break down the solids after separating them from the bulk of the water they process. This process produces, you guessed it, methane. Much like the power plant examples, Bitcoin waste mining creates a situation in which miners no longer need to be profitable. Mining simply needs to outweigh the opportunity costs of not mining. In the situations where the gas cannot be brought to market, anything is better than nothing. I think I see a world where gas flaring and venting is a thing of the past. Satoshi Nakamoto had to think differently to bring about the creation of an entirely different network of money and value. We now need to think differently to not only ensure the network survives, but to ensure human flourishing continues into the foreseeable future. Energy is not scarce, nor should it be. Bitcoin is the incentive that the world needs to become truly innovative to ensure cheap, clean energy is available for all. Bitcoin is human flourishing. I think he nailed it, guys. I mean, we've been talking about this stuff for a long time. I haven't ever seen it articulated this well. So, I mean, huge props as far as that goes for this article. Yes, it is an opinion piece, but Mickey Koss, good job. These are the things we've been trying to articulate on this channel for quite some time when we get in, especially to the argument of, environmental impact of Bitcoin and so on. That being said, we do have a huge rise in the cryptocurrency market happening today, with Ethereum being up all the way to almost $1,500 US. Bitcoin finally cracking that $22,000 price mark, and we need to talk about it. That's why you're here. That's the title of today's video. The first one, though, is the merge trade has begun, experts say, as Ethereum surges and ST-ETH discount narrows. This is going to be extremely important because we need to monitor it as we get closer and closer to the merge. My assumption here is all the way up to the merge, we're going to see a lot of speculative purchasing. We're going to see a ton of retail purchasing. We're going to see Ethereum continue to go up. and potentially completely kind of skyrocket for what we would typically consider in a bear market like we're seeing right now. So I'm saying it's going to throw it off, right? And we're going to see Ethereum outpace Bitcoin, I think, even here, because people are excited for this. And even though we're in the know, we understand some things that are happening in the background of Ethereum that make it, sketchy in a lot of people's books, including mine, where I'm like, this entire thing of not being able to extract your staked Ethereum post-merge, I think that's going to have an impact on the market post-merge. These types of things, it doesn't matter because the retail market is looking at it and saying, oh, they're successfully moving to proof of stake. They also don't take the downsides of proof of stake. They also don't understand that it's the number 2 proof of work coin, which means, of course, there will be a new number 2 proof of work coin that will probably skyrocket in price as well. Which one that will be is yet to be seen, though. ETH has undergone a rapid change in narrative over the past week, with speculators purely focused on the upcoming merge as the catalyst for appreciation, one observer said. Renewed clarity about the timeline of programmable blockchain, Ethereum's highly anticipated transition to a proof-of-stake consensus algorithm, seems to have galvanized investor interest in Ether and its staked derivative on Lido Finance called ST-ETH, offering a reprieve to the battered cryptocurrencies. On Thursday, the Ethereum Foundation member Tim Biko suggested September 19th as a provisional launch date for the merge. We've already reported on this, of course, which will see the world's biggest smart contract blockchain transition from energy-intensive proof-of-work consensus mechanisms to a more environmentally friendly proof-of-stake mechanism. I'll refer you back to this article to rebuttal this statement by CoinDesk, by the way. Since Biko's announcement, Ether has rallied roughly 22%, hitting a one-month high of $1,475, according to CoinDesk data. The token registered a 15% gain in the 7 days to July 17th, the biggest jump since March. The staked Ether's discount relative to the price of Ethereum has narrowed to 0.98 from 0.96 since Thursday, per data source CoinMarketCap. The token, representing an equivalent amount of Ether staked in Lido Finance, is supposed to trade at a price closer to Ether. ST-ETH's price fell into a discount of 0.93 to ETH following the collapse of Terra in May and has not been able to recover since. Lido Finance is a liquid staking protocol, allowing users to stake coins while retaining liquidity and bypassing the burden of owning a minimum of 32 ETH to become a staker. It also bypasses the burden of not being able to retrieve it, right? Because essentially, you can kind of still trade the ST-ETH back to ETH as long as the pools are equal, but we do have an inequality in the pools still between ST-ETH and ETH, so keep track of that as we get closer to this. Users can redeem staked ETH for ETH only after transfers are enabled on Ethereum 2.0, and this is where we run into the crux that we've been talking about. Per the timeline from Tim Biko, we also know that withdrawals will not be enabled post ETH 2.0 or post merge. ETH 2.0 is not a thing now, but we've gone over that before. The reason why ETH 2.0 was rebranded is because the merge is completely separate from scalability. We aren't going to be getting scalability with this upgrade or anything like that. All we're getting is the move to proof of stake. And on that timeline, post merge, there will not be any sort of withdrawals allowed for the people that are staking 32 ETH. What does that mean for the people that are holding the token? Well, that's yet to be seen. The token can technically be swapped between, ETH and ST-ETH back and forth. And depending on how much liquidity is in those pools, it could impact Ethereum negatively. Here's where retail can get themselves in trouble too. And that's what I wanted to point out. There's a whole bunch of people purchasing up a bunch of ST-ETH and then planning to sell it post merge. They need to be aware that that staked ETH that is being represented by the ST-ETH is not actually withdrawable by whoever has that staked Ethereum. So what ends up happening or potentially happening is that you have a liquidity pool that is imbalanced, where you end up with 80% of it being Ethereum and 20% of it being ST ETH, and you can't get it out. That actually did happen here recently, where it was an 80-20 kind of mix. It's starting to come back in that kind of balance because of people purchasing it up, expecting the merge. But the kind of underlying factor here that a lot of people are missing is that the merge is not going to enable withdrawals. That will come in a later EIP, as stated by the roadmap for this particular merge. ETH has undergone a rapid change in narrative over the past week, with speculators focusing on upcoming merge as a catalyst for appreciation, said Matthew Dibbs, COO and co-founder of Stack Funds. Adding to this, we believe that there's a significant amount of sideline capital that has been waiting on bullish momentum to establish new positions. Several observers consider Ethereum's impending transition equivalent to 3 Bitcoin halvings, a programmed code that halves per block Bitcoin supply every 4 years. That will lead to a 90% reduction in Ether's annual issuance. Simply put, the transition is likely to bring a store of value or deflationary appeal to Ether. The upgrade has been long pending. Like other market participants, other investors tend to factor in bullish developments in advance. For instance, Ether rallied over 60% to $2,800 in the 3 weeks leading up to the London hard fork implemented on August 5th, 2021. The hard fork activated a mechanism to burn the portion of fees paid to miners. The Ethereum 2.0 upgrade has been long overdue and has seen several delays. However, the recent successful merges of the Ropsten and Sepolia testnets and the Goerli testnet's planned transition to proof of stake for August 11th has raised hopes for the mainnet merge in September. The foundation's strongest hint of the tentative date of the merge on record came as the crypto market looked for reasons to bounce, having priced in much of the bad news over the past 2 months. Ether tanked 60% to less than $1,000 from $2,700 in the past 2 months, as fears of faster liquidity withdrawal by the Federal Reserve, Terra's collapse, and the eventual bankruptcies of crypto hedge fund Three Arrows Capital. Several crypto lenders saw investors dump crypto holdings. Any positive news at this point is a welcome thing for markets, Jason said, market associates at Delphi Digital told CoinDesk on Friday. But it's definitely not the only reason ETH is up. Jason added that the bounce is typical of market action expected following the collapse of May and June. John, a managing partner at Singapore-based Signum, something like that, voiced a similar opinion, saying the market has priced in macro and crypto-specific risks and is now focusing on the upcoming positives. My only opinion is ETH is rising in anticipation for Ethereum 2.0, he said. Also, major firms have collapsed, and inflation announcements, I believe, have been factored in. I do see recovery for both ETH and Bitcoin should this accumulation phase hold throughout July. But we have to be mindful of regulatory impact, which I believe is coming. I do not see that dampening the markets. Ether's bounce is accompanied by renewed user demand for the blockchain, a sign the rally may have legs. The amount of gas or measure of what users pay to Ethereum network has increased from roughly 82 billion Gwei to 100 billion Gwei this month, according to data from Etherscan tracked by Galaxy Digital Research. And we are starting to see increases in revenue on mining Ethereum, so that sounds about right. The amount of gas used on Ethereum has spiked this month after several months of precipitous decline, indicating that Ethereum usage and demand for block space is returning following a period of relative disinterest. Christine Kim, research analyst at Galaxy Digital, wrote in a weekly newsletter published Friday. Notably, recent spikes in transaction activity are coming from transfers of ERC 1155 tokens, which are tokens that can possess either fungible, semi-fungible, or non-fungible properties. What's more, whales or large investors have recently bought the dip in Ether. Addresses holding over 1% of ETH in circulation have increased their positions, blockchain analytics firm Into the Block's weekly newsletter published Friday said. The total ETH balance held by address labels as whales reach an all-time high this week While this includes centralized exchanges, their specific holdings have been mostly trending downwards, while the staking contract and unidentified entities have been growing their assets. However, while the path of least resistance is on the higher side, it's probably contingent on the September merge, as developers have hinted. A potential delay could demoralize buyers. So we've been talking about this for a while. ETH has to merge, not only because of the issue with your ST-ETH pairing with ETH, but also because of the retail investors' perception of the coin. The problem you run into is that what is being told, as far as what proof of stake will do for the end users and for Ethereum, seems to be a little muddy and murky, and the way people are perceiving it is incorrect. This could end up going very, very poorly in September if the merge doesn't go well, and it could go even more poorly once people start to realize, of course, that their ST-ETH really isn't worth much because the withdrawals can't happen. Do we end up with huge DeFi contagion within September after the merge? Possibly, right? It's one of these questions that has been bouncing around in my head for a while, because is the merge good for the price right now? Yes. You kind of buy that rumor and sell the news, right? That whole thing. It really applies here with Ethereum, I think. And that's not financial advice. The reasons are technically backed, like I said, primarily based around ST-ETH and ETH pairings. But the whole cryptocurrency market is recovering, and a lot of it does seem to be leaning towards Ethereum, primarily, like we said, due to the fact that this news of the merge is happening. But here's where it gets really interesting, because what we've seen is an interest rate hike, to 9% essentially, right, in the United States. And there has always been this idea that Bitcoin and cryptocurrencies would be a hedge against inflation. Now, what happened earlier this year is that we had an economic downturn and the markets were going down. Your traditional stock markets, right, are going down, and it started to appear that the cryptocurrency market was following traditional markets. But as I look at it closer and closer, I'm not sure that's what's happening, because if I look at it from the perspective of Son of a Tech in September of 2020, that Son of a Tech would have said, well, sometime in 2022 or 2023, we will see a dip of Bitcoin down to about 21,000, and it will maintain that until the next halving in 2024. So this price is completely expected, right? Based on not traditional markets. I wasn't predicting the traditional stock market to go down, or a recession, or the impact of the lockdowns on the price. I wasn't looking at any of that. All I was looking at was the halving cycle of Bitcoin and how it affects price. So if I look at it completely objectively and step into Son of a Tech from 2022 shoes, I go, well, maybe it is a hedge against inflation still, because it's right where I expect it to be. And if it was following traditional markets, I would expect it to be 10 to 40% lower than it currently is. Meaning that the top price that I would have expected for, Bitcoin, the top price, not the bottom price, would have actually been around $17,900 with inflation considered in, now that we know those numbers, or down even, further than that, down to like 13,000 or something. So is it a hedge against inflation? Potentially. What we have here is Bitcoin is up and gold is down and the euro is dragging, and that is all tied together, they say here on CoinDesk. Bitcoin, the inflation hedge, the prodigal child returns. The U.S. Bureau of Labor Statistics released the Consumer Price Index, CPI for short, the inflation number for June this week. So macro trends are this week's featured flavor, because the CPI number wasn't exactly pretty. From the press release, over the last 12 months, all items index increased 9.1% before seasonal adjustment. So if you're an American who didn't get a 9.1% pay raise last year, which most didn't, then everything is more expensive. If you dig into that, what made that 9.1%, the really important stuff, food and energy, outpaced it. Food prices rose 10.4% and energy prices were up 41%. And that's why I said, really, if we're looking at Bitcoin, I would have expected like a 40%, decrease in price based on these energy prices, etc. But the energy prices are kind of the inflation of the energy prices, right, are kind of what is holding Bitcoin where it's supposed to be, interestingly enough. Of course, that means gold, the classic inflation hedge asset, should be going up, except it didn't, and Bitcoin did. Also, the euro dollar is the euro is a dollar stablecoin now. What gives? If you spend a lot of time or a lot of space in this newsletter on soapbox because of inflation, I'll spend a lot of space in this newsletter on a soapbox because inflation really annoys me, but also because a son of a Greek immigrant, I find the euro to be really annoying, and gold as a monetary asset never really made sense to me. Plus, I really like Bitcoin. Since a lot of things have been said about all of these things recently, there's a lot of him to latch on to, so here is his opinion piece. Inflation is good for you. Google it. Real life articles have been published that claim this, and they're serious. Inflation is good for you because it favors debtors. That makes sense. If you have a $100,000 loan, that $100,000 doesn't adjust as things get more expensive. It's still $100,000. So if that $100,000 is a fixed rate 30-year mortgage, then your debt burden is lessened. Assuming, of course, that your wages increased enough to make up for the fact that burritos are more expensive. For the record, wages largely didn't increase enough in the US. So while inflation might be good for your mortgage burden, doesn't make up for the additional 40% you're paying at the gas pump or the additional 10% for burritos. We need inflation. Google that too. Plenty of articles, all serious. The basic gist of the argument for needing inflation is that deflationary currency, once that increases in value over time rather than decreases, will lead to excess saving and lack of spending in the economy given the time value of money. TVM is the core tenet of finance. A dollar today is worth more than a dollar tomorrow given the earning potential of that dollar. Except that's a whiteboard world. In the real world, there's nothing wrong with saving. Also, and this should be shocking to absolutely nobody, people buy things because they either need them or want them. While they may be doing TVM calculation implicitly, no one is pulling out an HP12C to decide if they want guac on their burrito. There's a really good theoretical argument for the fixed rate 30-year mortgage mentioned in the previous section as an effective inflation hedge, but don't give Wall Street any ideas again. But normally gold is touted as the ultimate inflation hedge. Gold has been money for millennia, and it's relatively rare, and it's difficult to produce more gold. So in times of high inflation, we expect gold to increase I don't know that word. I got to look that one up. Commensurately. All right, we're going to give up. But I am going to Google it and see what it means. Yes, I'm just a silly redneck that has to look everything up. Corresponding in size or amount of degree. Okay, that makes sense. All right. Except now we have gold 2.0 and Bitcoin. Here's how both have fared since the June CPI was announced. Bitcoin took gold. Look at me. I am the captain now. I know this is a very short cherry-picked time period, but it's pretty profound. Bitcoin is finally doing that thing you expect it to do as gold 2.0. Maybe Bitcoin can be an inflation hedge after all. Last week, for the first time in 20 years, the euro hit parity with the US dollar. CoinDesk Omkar Godboll, there we go, something like that, wrote a great article about what that might mean for the crypto markets. In the article, Genesis Global Trading's Noel Akeson, my former boss, was quoted saying that Bitcoin has been negatively correlated with the dollar index the past couple of years. So far this year, this trend has held up. The dollar index has performed extraordinarily well, up to 12.3%. The euro compared with the dollar hasn't, negative 10%. And not to be upstaged, Bitcoin has done even worse at negative 56%. Setting aside both crypto and my negative bias against the euro and its troika, which is so graciously bailed out by Cyprus, Ireland, Portugal, and Greece, for a moment, it will be interesting to see what the European Central Bank will do in the face of a weakening euro. Looming gas shortages, increasing energy prices, and impending recession. Hard times in the Eurozone might beget hard times elsewhere. For all of Federal Reserve Chairman Jerome Powell's woes, at least he isn't ECB President Christine Lagarde. Thankfully, it's 2022, and in 2022, Bitcoin is a real macro asset. So all of the things that happen in the broader economy affect Bitcoin. The hard times in crypto that I wrote about the last few weeks may become harder times if things in the economy get worse. Sure, Bitcoin could be a way to opt out of the current financial system and get away from inflation and poorly run monetary unions, but for now they are tied together. So there you go. All right. What are we learning here that's interesting? Well, the biggest interesting thing is that Bitcoin is outperforming gold. And then the second, I think, as far as all this goes, is going to be, well, the fact that, I mean, we're in a recession, right? So, I mean, I think that, man, I've been dealing. Look at this! Holy moly! We just cracked $1,500 on Ethereum. Yeah, Ethereum's just cranking. We're gonna get into mining profitability, but I have to answer the question because this is the question that everybody had. So, my opinion is: the crypto market recovering? No, the crypto market is doing exactly what I expect it to do, right? Like we said before, we expect the price of Bitcoin between 18 to 22,000. And we expect it to remain there until 2024. I wouldn't change that opinion yet, except of course the broader market does affect it to a certain extent. And if the dollar keeps continuing to become worth less and different traditional finance institutions become worth less, like the euro, then we will see technically a price hike in Bitcoin, but its intrinsic value still remains the same, which means I still think we have an impact of the halving cycle on everything. Now, where things get really interesting from the mining perspective of things is like the article we talked about earlier, which is, you know, Bitcoin mining doesn't need to be as profitable. And I think from our perspective as miners, with the merge coming up on Ethereum, there is this kind of uncomfortableness with the fact that Bitcoin is completely taken over by energy companies. The margins are so extremely low that we can't be profitable on it, and we have to look to other options. We'll be talking about some of those options though here too in just a second. But let's get into mining profitability right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. All right, welcome back, everybody. So, first things first, we'll just get into it. I have all my miners right now on Ethereum at Crazy Pool, just because I think that it was just easy to maintain as we rebuild all the units out there. Last 24 hours, we've done $98, which is obviously much better than what we had been doing previously on just Ethereum with the whole farm. Now, I have a lot of hash rate offline. We're only at 4.25 gigahash right now. We'll be getting more of that up because, as you can see behind me, we have all the cases to start getting everything up. So, yeah, thanks to Octominer. They're still supposed to provide me with an affiliate link and a coupon code for you guys, so stay tuned for that. Hopefully we'll get that going for you guys here soon. But overall, not that bad. I've been building some nodes though. So I built an Ergo node and Ethereum Classic node. Kind of probably start to see why as we talk about profitability on the 3090. Ethereum is going to be in first place though. We finally have the 3090 over $3 a day. It's been forever since we've had the 3090 over $2 a day in profitability. I mean, after power. Like, it's been forever. Now, obviously, this is because the price of Ethereum is up significantly. But it's super awesome. And we have a second option over $2 a day in Raven Coin at $2.14 a day after power. And we even have a third option over $2 a day after power with Neoxa. We have 3 options right now as it sits over $2 a day at 10 cents a kilowatt hour. So even if you're worried about the Ethereum merge right now, you still have a profitable coin to pick from that's over $2 a day. It's pretty nice on a 3090. So we also have Conflux at $1.70 a day. We have Cero at $1.67 a day after 10 cents a kilowatt hour. We had a huge price pump from Ethereum Classic, putting us at $1.60 a day after power. Firo at $1.52 a day after power. We have to scroll down here to Flux, which is $1.31 a day after power. If you mined a nice hash, it's $1.43 a day after power. And then Ergo's way down here at $1.16 a day after power. But, you know, all of these are up over $1 now too, where they, as opposed to Friday where they were all down, you know, below $1. So things are looking good today from the mining perspective. We are starting to see some recovery as far as mining revenue goes. The question would be, and I'm curious what your strategy will be here. Are you going to hold that cryptocurrency that you're mining, right? Or are you going to put it into a cash position? And that's where we sit. Now, here's where things get really, really interesting too, because we're starting to see some recovery. Does that recovery maintain? If that recovery maintains, right, and we start to see a resurgence in mining again, things could get really interesting because, you know, we have this huge argument going on in the PC gaming community. I don't know if you guys are aware, but you have Jay's 2 cents going out. He knows something. Or at least he's acting like he knows something. And he's telling people to go out and buy GPUs right now because they're never going to be cheaper than they are right now. Everybody else on the internet's against him. Now, initially when I watched that video, I was like, what are you talking about? Like the 40 series and the 7000 series are going to come out. The ETH is going to go to proof of stake. GPUs are going to flood the market and it's going to be insane. But if we have a recovery within the cryptocurrency market and shortages get applied again, do we just have a much faster cycle as far as all of this goes? This is really interesting stuff and to take a look at, I think. Now we do know that Jay's 2 cents has some insiders at NVIDIA. So maybe he does know something that a lot of us don't know. I'd like to hear your thoughts and opinions on it, because when I was looking at that and then I start to see the recovery here, maybe people start going back out and buying GPUs again. We still haven't really seen the 3060 Ti or the 3070 Founders Editions, available on shelves. So I do know there are some miners still picking up 3060 Ti's and 3070s. They're also two of the only cards that didn't get a price decrease from NVIDIA officially on their MSRP. And they're basically the two most efficient cards for mining right now. So There are still some miners out there too that appear to be picking up cards to a certain extent. Let's look at mining pool profitability though. Last 90 days, Ether mine in first, Crazy Pool in second, Mining Pool Hub in third. Last 60 days, ZT in first, Ether mine in second, Crazy Pool in third. For the last 30 days, Mining Pool Hub in first, Ether mine in second, F2 Pool in third. For the last 21 days, Mining Pool Hub in first, F2 Pool in second, Hive on in third. For the last 14 days, Mining Pool Hub in first, F2 Pool in second, Ether mine in third. For the last 7 days, Mining Pool Hub in first, F2 Pool in second, Ether mine in third. For the last 3 days, ZET in first, Crazy Pool in second, Ether mine in third. And for the last day, Crazy Pool in first, Mining Pool Hub in second, Ether mine in third. Now we also have to look at ASIC mining profitability over here. So let's pop into there and see what kind of recovery we're getting there. The L7 is still sitting in first place at $24.48 a day. And that is up from about $20 a day. So about 20% up, something like that. The KD6 is back over $20 a day. The KD5 back over $10 a day at $12.72 a day. And then if we scroll down, we have the S19 Pro at $4.36 a day. Almost everything is up as far as that's concerned, except for Bitcoin, right? Bitcoin mining is still extremely competitive. So let's take a look at the hash rate and see if we're having a difficulty increase. Not necessarily, and we're still sitting pretty low on hash rate at 218 exahash a second. Hasn't changed that much. Are more people turning back on to Ethereum? Not really. Still right around that 900 to 930 terahash a second. So the people that have sold off are done. The people that are sticking around are going to get the benefits of the Ethereum pump before the merge, it looks like. Ethereum Classic, we are up about 1 terahash. I think that's due to this huge 53% pump in price up to $22.72. I would have expected more by today. I did see this happening yesterday on the live stream because we live stream every evening on twitch.tv/blindrun at 6 p.m. Central Time. If you want to check out more content over there, we were looking at this. It was at 24 terahash a second. It's only up a terahash a second, but it's up 53%. It's interesting too because the what to mine calculators don't seem to be calculating this out as well. So what I'm going to do, Crypto2Cal, we're going to go look over here as well because this calculator might be updating a little bit more. I mean, Ethereum has pumped a lot. Bitcoin Gold way up there for some reason. But let's go ahead and just throw a single 3090 in here so we have a similar to compare to. Yeah, Ethereum Classic is much more profitable than what to mine is showing. It looks like it's at $2.16 a day. Interestingly enough. There was a pump on Ravencoin here today as well of 19%. We'll have to see if that sticks around. So let's look at Ravencoin and see if Ravencoin has had a corresponding increase in hash rate. It is not. So Ravencoin's another interesting one to take a look at here. We're having a lot of fun, I think, in being able to determine, I think from a mining perspective, a GPU mining perspective, especially a home miner, we just have a lot of options to play around with, and it's making things a lot more fun. It looks like Ergo's had a nice little drop in hash rate. It's down to under 11 terahash a second, and a corresponding price difficulty drop as well. Flux is at 1 mega solution a second. Let's take a look at Neoxa because that one's been pumping a lot lately too. It's right around 222 gigahash a second. So that's pretty much what we're looking at. Let's get into questions and answers. And remember, super chats are never required, always appreciated, first to be answered because they're the easiest to read. Tagging @SonOfATech at the beginning of the message will highlight the message orange and make it easier for me to read as well. And then, if you guys don't mind, super chat stickers are the best to boost the algorithm. And if you want to support the channel monetarily, the place where I get the most cut is at sonofatech.locals.com. Now, a lot of people are getting a little crazy in chat. So chill out. No reason to curse at each other, all right? Detroit Iris says, Sonofatech, I cashed out, just sold 100 ETC for Bitcoin. So sold 100 Ethereum Classic on that pump for Bitcoin. There you go. Matt 2K does not agree with Jay's 2 cents. Ara2 says, Ask Tech, Jay's 2 cents mentioned the other day he believes there is a good chance NVIDIA will push 4000 series out to 2023 due to overstock of the 3000 series AIB manufacturers upset with NVIDIA. Makes sense. I don't know if that'll happen though. T-Gig says, Ask Tech, apparently the 4000 series are going to cost more than expected. With recession, gamers will realize they want 3000 series, causing them to go back up in price on the used market. And that was the argument that Jay's 2 cents had, right? To a certain extent. And that's an interesting one to have because the performance bump of the 4000 series is very high, right? Now, it's going to be difficult to predict because supply shortages could happen again, but I can't tell you for sure that they're going to happen again, right? It's me says, Ask Tech, hey, I always thought that network hash rate is the sum of pool plus solo hash rate, but it does not seem to be the case in mining pool stats. Bitcoin is the example. What did I miss? Nothing. It's always been, it's the network hash rate is the network hash rate. Like, it's not like you get a different network hash. Like, the network's not going to distinguish between pool hash rate and solo hash rate. So you're only really going to ever get a total hash rate, right? Now, when you look on mining pool stats, technically the one on the left, and the way it gets calculated gets a little messed up, but the one on the left is supposed to be all of the hash rate within the pools, and the one on the right, I think, includes solo. Or maybe that's reversed. I think that, that's right, I think. Because they can pull all the hash rate from the pools, but that doesn't mean that necessarily they have all the pools added either. But that's one way you can get an idea of how much is being soloed. But they also include solo mining pools, like 2 miners. So the numbers are never going to be exactly right, basically, because it's all pulling from APIs. The API data can be behind. This is why what to mine is behind on their profitability for Ethereum Classic, for example, so on. Harvey says, Ask Tech, do you think Gamers Nexus is a good place to learn the basics of computer components, especially GPUs, and how to properly build? I think Gamers Nexus does a great job, yeah. Back in the day, maybe you would look at, old Linus videos, but they've kind of shifted the way their channel works to appeal to a larger audience, but there's still a lot of good information on there. If you're really wanting like a lot more in-depth technical stuff, I do think like Gamers Nexus is great for that. Hardware Unbox used to be really good. There's still like the I think if you want to get into more IT focused infrastructure, etc., less gaming focused computer components and stuff, I think Craft Computing is my favorite right now. I think I would check him out. Ara Dale says, Ask Tech, I bought a fake antenna angles off the Ergo auction, or you bought a fake Aneta angels off the Ergo auction house. I didn't know how to check the minting address. Maybe do a video on NFTs. Only lost $30 of Ergo, so no big deal. Yeah, that would have been a steal for a regular angel, huh? All right, man, I'll try to check it out and see if we can do a video on making sure people don't get taken. IATG says, Ask Tech, what are your feelings on Bitcoin Gold? No real feelings about Bitcoin Gold other than I've never trusted it. It's been around for a long time, but I want Bitcoin. You know what I mean? Gabe says, Ask Tech, do you have to pay import taxes on the Octos? Yeah, so I didn't pay shipping or anything because that they're helping me out with the channel. And Chili's down here locally. We're going to be doing a video with them soon, but I'll be getting all that information for you guys. There are tax implications. I don't know if they include VAT in their pricing. I'll ask Chili. I've been trying to get more information from them as far as all that goes. For example, though, you have to be careful on sites like BT Miners where some of the stuff will have higher shipping and VAT costs. You know, the new partner Coastal Crypto that we did the video over yesterday with the Antminer S10. Right now you can get 5% off with promo code SOAT, but they don't have any of those additional VAT prices or anything like that on any of their equipment, so it can make it a little easier. But all of the stuff that comes from China can be like a little stressful to calculate out, right? Like you have to go through, figure it out. For example, like a lot of people were like, the BT miners price is expensive at, you know, I think 11.9 compared to like buying the E9 directly from Bitmain. But the amount that you had to pay in Bitmain for the shipping, etc., was much higher. So you have to go through the process almost of like adding these mining parts into your cart and seeing what the true price will end up being before you purchase it. And you want to do it on multiple sites, right? So like for me, I would pull up Coastal Crypto and BT miners, take the miners, even though they both have different prices that are advertised and listed. Once in the cart could be either comparable or completely different. So you want to make sure that you're doing that due diligence before you're purchasing anything. Miller Mining Company says, Ask Savatek, I feel the instability of the merge has been part of the crypto crash regardless of the 4-year halving cycle. Whether or not it works, and I hope it doesn't, the finality date is good. No, I'm kind of glad to get this over with. I know like a lot of people are like, I just never want it to happen. I want to keep mining it. Why do you want to keep mining it, right? Especially if you consider the fact that if it doesn't merge, it's going to just go down in price, right? Because the retail is expecting that. Chilled Zone says, Ask Savatek, if my 2070 Super is artifacting in Windows under load, could it be heat? Yes, it could be heat. Can you still mine or should you shelve it? You should check your temperatures and see if you need to replace thermal paste and pads. You can use hardware monitor or hardware info is my favorite to check all of that, so definitely do it. Forever Metalhead says, Ask Savatek, Builder Boy is a nice channel with a lot of traffic on info on motherboards, etc. Nice. Colton says, Ask Savatek, so I guess it's the wrong time to transfer Bitcoin to ETH. Not necessarily, no. I would assume that there's going to be a price pump with a successful Goerli merge on August 11th. And then probably another price pump on a successful merge initially. So I think like there is potential, and not financial advice, but I think that there is potential for Ethereum on 2 more dates at least. Aggieland says, Ask Savatek, can I buy just one of the X12s from you? No, I can't sell them. Sorry. Anthony Hawking says, Ask Savatek, is the Rocket Chat still up? Yes, it is still up. I'm logged in right now. You can email me, though, at inquiry@sonofatech.com if you're having issues and we can get it figured out. All right, boys, I'm off to jiu-jitsu. We went a little late today, obviously, because we were carrying in rigs. Please hit the like, comment, subscribe, and notification bell so that the channel gets that additional boost on the algorithm. I think that we learned a lot today. I did, so I hope you guys did as well. And I will be getting out to the farm and starting unloading these later today. So we'll be probably doing a vlog. And then I have I've been going through and getting details on building nodes. So if you guys are interested, I am working on how-tos for building nodes, and I will probably do both a written version on my Substack and my locals, as well as a video version. So stay tuned for that. I think Ethereum Classic and Ergo will be the 2 main ones that we get going. I'll see you guys next Tuesday.